Why is the third year in a US presidential cycle so important? Let's get to that right here, right now, because as you'll see, the returns in the third year generally significantly outpace returns in any of the other 3 years. Why is that the case? Let's address it right now. Hey guys, I'm Rob Tetrault, and today we're talking about the US presidential cycle and why year 3 is a dominant year for the US presidential cycle. 2023 is a third year of a cycle, and let's address why historically this has done so well. First off, props to Stock Traders Almanac founder Yale Hirsch, who's the individual that thought of this idea and put it out there in his book, The Stock Traders Almanac, which started, I believe, in 1967. And his theory was that stocks perform kind of weaker in the first half of the election cycle and stronger in years 3 and 4. The theory is predicated on the view that a shift in priorities for the presidents happens over the duration of their time in the cycle. So the first year, they got to pay people back, they got to pay some favors. They're not willing to spend as much because voters have a short memory, right? Voters want to be able to remember what happened recently. And in a nutshell, the US presidential cycle kind of starts the election in January, February, March of the fourth year. So year 3 is the year where presidents will often lay out a bunch of spending, give a ton of benefits, and generally encourage the economy to get going. And when you're encouraging the economy to get going, that's creating spending. Sometimes there'll be some tax cuts. More spending means more profits for companies. More profits for companies means better earnings. Better earnings for companies in a healthy economy typically leads the stock market much higher. And that's what we've seen over the course of these US presidential cycles. Now, obviously, take this with a grain of salt, and I'm not telling you to load up on stocks just because it's the third year of an election cycle. Big disclaimer here, we don't know what'll happen in the year, obviously. And we're only reviewing past history. Past history is not an indicator of future performance. Now, this is the same guy who coined the Santa Claus rally. He's also the guy who coined the, sell in May and stay away type thing, where figured out that the kind of late spring and summer months into the fall were weak months for the stock market, and the strong months were kind of like November to May. These are some ideas that he had, and we're just talking about them here and what they are. So the model predicts that the presidents are going to focus on shoring up the economy in order to get reelected. So as you're shoring up the economy, you're spending, and typically it's been very consistent regardless of which side the president is leaning, whether it's a Republican or a Democrat. Year 3 has been very, very strong historically. Now let's get to the data. The data suggests that year 3 is quite strong. And in fact, it's a 16% average return. This is going back just basically to the Great Depression. If we look at the last, call it 100 years, the year after the election, markets up 6%. Second year, up another 6%. The third year, 16.3%. And the fourth year, 6.7%. So we can see that the other 3 years are all relatively the same, 6.7, 5.8, 6.7. But year 3 is the gangbuster years where the market performs 16.3%. And that's returns for the S&P 500, which is the index that we should be measuring, given that it is a US presidential election cycle. The other thing that we got to factor in here is the percentage of time that year 3 is positive relative to any other year. So since 1933, the stock market has been positive 70% of the time, 70% of the time. However, year 3 of a presidential cycle, 82% of the time is positive. And during the first 2 years, only 59% of those years is the market positive. Now, this data comes from a researcher at Charles Schwab. His name was Lee Bohl, and he conducted a thorough review of all the data for presidential cycles. If you look at the last election cycle, President Trump promised a whole bunch of tax breaks in year 1. So boom, came off to a good start. The S&P was up 19%. Second year took a 6.2% dive, but that third year was very, very strong for the equities. The S&P surged 28.9%. Now here's the big problem about this theory. There's only limited number of market cycles. We're talking about 20 cycles of data here, 25 cycles of data. So we're not talking about a lot of years of data. My big beef with this is that even if the two variables are correlated, so the third year of the election cycle and the phenomenal performance, is there causation? Does one cause the other, right? It could be that markets tend to surge in the third year of their presidency, but not because anything that the White House is doing. Given that there are so few data points here, I would simply caution any viewer to just not build your portfolio and not base your entire investment model around the fact that every 3 years the market's supposed to do a lot better. Instead, what I would preach is take advantage of situations where you can. Take a look at this third year in line with your portfolio. And does it make sense to maybe change your asset allocation a little bit? And if it does, what does that look like? Talk to your portfolio manager. And if you don't have a portfolio manager, reach out to someone like us. Go to www.speaktorob.com. This is what we do. We'd love to discuss this. No obligation consultation with you, 30 minutes. Figure it out. We could hammer out some of these questions, these details, and see if there should be a shift in your portfolio. Most likely you don't have alternatives. Most likely you have very little exposure to some inflation protected investments. Likely nothing on the private infrastructure, music royalty side. There's probably a whole bunch of work that we could do with your portfolio, but you got to reach out. Go to www.speaktorob.com. And remember, small data, but the data is remarkable when you think that it's 16% versus 6 on 20 occasions is pretty significant. So there you have it. The US presidential cycle, year 3, historically is the strongest year. Take it with a grain of salt. Past performance doesn't guarantee future results. Thank you so much for viewing, guys. Take a sec to like, subscribe, press the bell, make sure to follow, and we'd love to hear your comments. If you agree or disagree, put them below. Thanks for tuning in, guys. I'll see you in the next video.